Yeah, hello and assalamu alaikum. I hope you people are doing well. So welcome to the session. I'm just gonna start off the session of today. Some of you would be having an examination of Diploma in IFRS tomorrow. Some of you would be having the examination day after tomorrow. So wish you all the best for the examination. The agenda of the session right now is I wanted to have a discussion of one of the past examination questions. So I would go about discussing uh, with the I would go about with the discussion of the examination, this latest examination paper of the Diploma in IFRS. How many of you have actually tried to do this DipIFRS examination, latest examination?
Recording in progress.
Okay, so what I'm actually going to do is that I'm going to go about discussing the June 2023 examination paper. And what I will be doing is that I'll be doing this on the ACCA CB practice platform so that you people can actually see that. And whenever I would be needing, I would be actually using I would also be using the spreadsheet or the Word document also. And plus, if I actually need, I would also be using I would also be using my notepad so that I could make some annotations and could actually guide you people through. So let's have a bit of a discussion about this. So this is basically the June 2013 examination that was recently held by the ACCA for the Diploma in IFRS. What I would do is that I would try to go about this specific paper so that I could take you people through. Okay, so the Diploma in IFRS examination for the June 2023, as you could see that these are generally the windows that would actually be appearing on every examination paper that you would go about. So we have actually opened up the examination now. And let's just start off, let's begin with the examination. So in front of us, we have got question number one. In front of us, we would have actually got the question number one. The question number one is about alpha. And what does it say? It says that alpha, uh, alpha, a parent company with two subsidiaries, beta and gamma, is preparing the consolidated statement of profit or loss for the year ended 31st December 2009. The following exhibits available on the left-hand side of the screen provide information relevant to the question. So we have been given these information. So there is this basically whatever the exhibits that are available, but the first important thing is that let's just read through the requirements. It says using exhibits number 1 to 4, prepare the consolidated statement of profit or loss for the year ending 31st December 2009. You do not need to consider the deferred tax effects of any adjustment. No explanation of consolidation adjustments are required. So there is no explanation of the consolidation adjustments that are required. All that you have to do is that you have to prepare the consolidated statement of profit. Let's just have a look at the spreadsheet that is given to you people in the examination. And if you would look at the spreadsheet, so what's actually going to happen is that the spreadsheet that is given is already pre-populated spreadsheet. It already has got a lot of information. So that is what is given to you people. Now, let's talk about this. The first one, it says the draft financial statements. Let's look at this. It says, in fact, the spreadsheet is not pre-populated. Okay, just look at this. Let me just see. If I could just zoom it out a bit. Okay, 100%, make it 100%, make it 100%. Okay, F11. Now, what does it say? It says this spreadsheet has been copied in the response option. So when you would look at this response option, they've already copied this. The revenue, the cost of sales, the gross profit, the operating expenses, profit from operations, investment income, finance costs, etc., etc., etc. All of this has been copied. Then what else do they have? They've got the total equity on the 1st of January 2009. Plus they have got the profit for the year. Then in addition to this, they've got the dividends and they've got the total equity and so on and so forth. Now what next is there? The next situation is that let's have a look at this alpha's investment in beta. That's exhibit number 2. Let's have a look at this. Now, what is he actually mentioning in this exhibit? Whatever that he's mentioning, what I would want you people to do is that to just read it through for a minute and see what you think should be done with respect to it. Then we are going to start discussing it together. So can you just look at it? Can you just read through it, please? And can you see that what do we need to do with respect to this? Okay, so now what does it say? It says that on 1st of April 2004, Alpha acquired 80 million of the $100 million one equity shares of Beta and gained control of Beta. Alpha acquired the equity shares in Beta by issuing one new share in Alpha for every 2 acquired shares in Beta. On 1st April 4, the fair value of an equity share in Alpha was this, and the fair value of equity share in Beta was this. On 1st April 4, net assets had this. Alpha used the proportionate share of net assets method. Now it says no impairments of goodwill and acquisition of Beta have been necessary in the consolidated financials of Alpha up to 31st December X8. Beta is a single CGU. On 31st December X9, the annual impairment review of the goodwill indicated that the recoverable amount of net assets, including goodwill, at that date was so and so. Any impairments of goodwill are charged as part and parcel of the cost of sale of the consolidated statement of profit or loss. Now, see what's actually going to happen in this scenario. If you're going to talk about this specific scenario, so in this specific scenario, you would have to see this. Okay, so now basically what's happening is that you got to calculate the goodwill here because ultimately For you to be able to test the goodwill for impairment, you would have to actually see that if there is any impairment or not. Now let's just try to see that. See, if I talk about the spreadsheet here, the examiner has already given to you this spreadsheet, and the spreadsheet is pre-populated. All that you have to do is that you have to do the goodwill calculations in the spreadsheet. Once you would do the goodwill calculations in the spreadsheet, so you would have an idea that, okay, what's going on? Now see. Okay. So for the goodwill calculation, what do we need to do? We need to see that we've acquired 80 million shares and acquired the equity shares in beta by issuing one new share in alpha for every 2 acquired share in beta. Okay, so what you need to do, you need to say that the cost of investment. So for the cost of investment, you would say that number of shares acquired is what? Number of shares acquired is 80 million. So number of shares acquired is 80 million. Number of shares issued is gonna be what? Number of shares issued is gonna be, you are going to have issuing one new share in alpha for every 2 shares acquired in beta. So it's actually gonna be like this, equals to this multiplied by 1 divided by 2. Multiplied by 1 divided by 2. So 40 million shares are gonna be issued. The fair value of the shares is gonna be what? You have each and every share of alpha that you issued. The fair value of equity share in alpha was 3.2 and the fair value of an equity share in beta was 1.6. We don't have to consider that. We have to consider the fair value of the equity shares in alpha. It was 3.2. So you're simply gonna say equals to 3.2 multiplied by 40 million. So $128 million is what it is going to. Now, so if I need to calculate the goodwill, so for the goodwill calculation, the cost of investment is gonna be this. The non-controlling interest, you would have to do the calculation of the non-controlling interest, and then the fair value of net assets. Fair value of net assets is what you would have to establish. So if you want to calculate the fair value of net assets, does it gives the fair value of net assets? It says that alpha use proportionate share, okay. The net assets had a fair value of 100 million and this was equal to the carrying amount of the net assets on that date. So fair value of the net assets was what? $100 million. On 1st April, the net assets of beta had a fair value of $100 million and this was equal to the carrying amount of the net assets. I just need to see one thing. Okay, it says it was 100 million. So the non-controlling interest is gonna be this into 20%. Resultingly, what would happen is that you would have the goodwill, which is gonna be 48 million. So this is going to be the goodwill at acquisition. This is gonna be the goodwill at acquisition. So I repeat, this is actually gonna be the goodwill at acquisition, which is basically $48 million. So we've been able to calculate the goodwill using this information. What was the information? This was the information that was there. And on the basis of this, we have been able to calculate the goodwill. Now let's move a bit forward and let's discuss further. Let's come on to this. Let's come on to this specific exhibit number 2. Can you just go through this part, please? Yeah, can you go through this part, please? Okay, now see, it says details of acquisition on 1st of January. On 1st of January X6. On 1st of January X6, Alpha acquired 7.5 million of the 10 million $1 equity shares in Gamma and gained control of Gamma. Alpha paid $95 million in cash for equity shares. So what did they pay? They pay $95 million in cash. That's one thing. On 1st January 6th, the carrying amount of identifiable net assets in its individual financials were 70 million and fair values were 85 million. Difference was due to property whose fair value exceeded the carrying amount by $15 million. 11.4 million of this difference related to depreciable component of the property. Estimated useful life of depreciable component was 8 years, right? Now, all depreciation of property, plant, and equipment is charged to the cost of sales. Alpha used the fair value method for measuring the non-controlling interest. when recognizing the goodwill on acquisition of Gamma, the fair value of equity share on so and so was this, which used to be measured the NCI. No impairment of goodwill has taken place. Now, let's just try to do this one. This was the goodwill in beta. Now let's just try to do the goodwill calculation in gamma. Goodwill in gamma. For the cost of investment, what do we have? $95 million is what we paid, right? $95 million is what we paid. Then what happens is that the non-controlling interest, so if you want to talk about the non-controlling interest, the non-controlling interest is going to be what? It says that you acquired 7.5 million of the 10 million equity shares, right? Is there no audio or what? There is audio, I guess. So what actually happens is that out of the 10 million, 7.5 million shares were acquired by parent. So the remaining 2.5 million shares would belong to the non-controlling interest. And when it is actually going to belong to the non-controlling interest, so this is actually how the fair value of non-controlling interest is going to be 10.5.
Yeah, look, hello, sir.
Yeah, please. Yeah, please
So
go ahead.
in the initial goodwill calculation for beta, the
Yeah,
non-controlling interest, I've realized that you did 20%, which is the 100% because
yeah. Let me
I
just guide you
presume.
why. Yeah, let
Okay.
me just guide you why. Basically, what happens is that, see, in this specific one with respect to this, it said that the alpha used the proportionate share of net assets method for measuring NCI, right? Alpha
Okay.
used proportionate share. Here it says that the alpha is actually using, is measuring the NCI at fair value,
Okay.
right? That's where the difference is,
Okay. 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 All right.
right? You
So
get
the
my
other
point?
question was a bit silent with the fair
Yes,
value
yes,
figure.
yes, yes,
I mean, rate of fair value.
yes, yes, yes.
That's okay.
Okay, lovely. Now what next is there? The next situation. So we have actually got this what the non-controlling interest is there. Then what happens is that there is the fair value of net assets. So when we talk about the fair value of net assets, we've been told here that the fair value of net assets was 85 million, 85 million, 85 million, right? So this was 85 million. This was 85 million. Hence, resultingly, what happens is that this is what the goodwill at acquisition is going to be. So goodwill at acquisition is going to be what? The goodwill at acquisition is going to be 20.5 million. This is the goodwill in gamma. So we've been able to calculate the goodwill in gamma now. Right? Now, what next is there? Can you just go through this and see what is he saying with respect to the disposal? Can you just see what is he talking about with respect to the disposals? Okay, now it says that on 31st August 2009, Alpha disposed of its entire equity shareholding in Gamma for a cash consideration of 330 million. Income tax payable on this disposal is expected to be $38 million. On 31st August 9, Alpha credited the disposal proceeds to a suspense account. So what did they do? They said cash credit, they said cash debit, and suspense credit. Gamma represented a separate major line of business which the Alpha Group was withdrawing from. You can assume that the profits of Gamma for the year ended 31st December 9 accrued evenly. Now what we need to do is that we need to actually gain or loss on disposal of Gamma. How would you calculate the gain or loss on disposal on Gamma? You would say disposal proceeds. The disposal proceeds were 330 million, and then you would say less. There's actually gonna be goodwill, net assets, NCI. So hence there is going to be this gain slash loss on disposal. So let's say, for example, the goodwill was this 20.5 for the Gamma. For the net assets, we would have to do the workings. Now, how would we do the workings for the net assets? Let's just come on to this draft finances information over here. We already know that what is this Gamma all about? It was like the whole of the year, they had this profit of 126,000. The summarized statement of changes in equity, total equity was this. Profit for the year was this. Dividends, this. Now let's just try to do some calculation. So you would say that total equity for the 1st January 2009, profit for the year is this. The dividends were paid on 30th June 2009, then this total equity at 31st December 19. Now, what was the date of disposal? This was the date of disposal on 1st August 2009. So what do we need to do? We need to say that net assets at disposal date, profit, equity at 1st Jan X9. There is one thing that I've actually identified when I'm doing this question. Basically, the question, the whole of it is in terms of thousands. So maybe what we need to do is that we need to just do it in terms of thousands so that we could just make it a bit consistent. We could just make it a bit consistent. Okay, so the disposal proceeds are 330,000 because I'm just doing all the calculations in terms of thousand. Then what is happening is that the net assets need to be calculated. So for the net assets at disposal date, this is what it is going to be, disposal date. The profit up till (31st August X9). The profit for the year is how much? This is 126,000 multiplied by. Up till August, it was 8 months. So multiply by 8 divided by 12. So you get 84,000. The dividends that have been paid So the dividend will have an impact of reducing the net assets. Then fair value adjustment on acquisition needs to be added up, which was basically 15,000 because we were being told that it was a 15 million adjustment, right? Why? 85 million here and 70 million the carrying amount. So it's actually 15,000. The excess depreciation on fair value adjustment is gonna be what? We need to see 11.4 million is a depreciable amount, and the estimated useful life of the depreciable component at 1st January 6 was 8 years. So how many years have passed since 1st January 6 till now? So it's like equals to minus 15,000 divided by 8 years, multiply by 2006 has passed, 2007 has passed, 8 has passed, and this is basically 9. So 4 years plus 8 more months, divide by 12. So 8750 is gonna be the excess depreciation on the building on the depreciable component. How? In fact, I think 11,400 of this is depreciable. 11,400 of this is right. Okay, so this is the excess depreciation on the fair value adjustment. Now, what else is there? We need to know the NCI value also. So you will actually get the net assets at the date of acquisition, which is this. The non-controlling interest is gonna be like this. The non-controlling interest at acquisition is like this. Share of post acquisition reserves. Share of post acquisition reserves. So what is actually going to happen is that 25% multiply by 236,350 minus the net assets at the date of acquisition, which was 85,000. So hence resultingly, the non-controlling interest is going to be like this: 48,337.5. 48,337.5. Now what next is there? So basically, we had this goodwill, we had this net assets. The non-controlling interest has to be shown as a negative figure. So basically, this is the sum of what we had capitalized. This is the sum of what we had capitalized. So what happens is that this is the sum of what we had capitalized. Now what we would happen is that we would say that, okay, so now this is what we have capitalized. So hence resultingly, there is going to be a gain or loss on disposal. So there is going to be a gain on disposal of 121,487. So what is it gonna be? It's gonna be a gain on disposal of 121,487.5. 121,487.5. 121,487.5. So basically, what have we been able to do? We've been able to calculate this gain on disposal also. Now, what next is there? Let's talk about the other information. This was the investment in Gamma. Now let's just talk about the other information. Now, can you just do this, please? Can you just do this, please? Okay, now let's see. It says Beta has purchased goods from Alpha during the year. This is the first year in which Beta, in which intragroup trading took place. Alpha applies a markup of 1/3 to the cost of these goods when computing the selling price. So they apply a 1/3 markup. 1/3 markup actually means that 33%, right? Now, what next is there? The next situation is that it says It says that Alpha sold goods with an invoice value of $42 million to Beta during the year to 31st December X9. And at the end of the year, Beta still had some of these goods with an invoice value of 19.2 million in the inventory. Now, can you people calculate the unrealized profit on this, please? Can you calculate the unrealized profit on this, please? Can you please calculate the unrealized profit on this?
Is it about 14 million profit?
14 million?
Yeah.
Okay, can anyone else also confirm, please? Yeah, can anyone else please do it? Okay, now let's see. See, basically what happens is that Alpha sold goods with an invoice value of $42 million. So when you are going to calculate this unrealized profit calculation, so the unrealized profit calculations are going to be like this. For the unrealized profit calculations, just try to understand it's a sales cost profit. The markup is 1/3. Markup is 1/3. Equals to 1 divided by 3. So markup is 1/3, right? Now, if I actually express all of this in terms of percentages, so this is how the percentages is going to be. The sales value should be this. Now we've been giving the sales value. It was 19.2 million is the amount of goods that are remaining. 19.2 means 19,200. So this is actually going to be this divided by this multiplied by this. 4,800 is the unrealized profit amount. So the unrealized profit is 4,800. Is that okay? Now what next is there? Lastly, it says that the investment income which is shown in Alpha's statement of profit or loss includes the dividend received from its subsidiary entities. So the dividend income that has been received has been shown, right? It's a dividend income that has been received. Okay, that's okay. Now what next is there? We need to now.
Look, man.
Yeah, please.
So on the unrealized profit, is it the portion that is outstanding on the balance sheet.
Yes,
You
that's
need to-
19,200.
Okay. So what happens to the difference between the 42 million and the 19 million? Does it mean
Okay,
that has
that's sold.
counted?
That's sold. And on
And
that, it's assumed that the profit is realized,
counted. Okay. All right. That's correct.
right?
Thank
Okay,
you.
lovely. Now let's just see this. So basically what's gonna happen now, if we wanna do the group accounts calculation, so this is, I would say, adjustment number 1, I would say adjustment number 2, I would say adjustment number 3, and then I would say group accounts, right? So this is what I have done here. Now, basically, this company, Alpha plus Beta. Now, was Beta your subsidiary for the whole of the year? When did you acquire Beta? You acquired Beta on 1st April 4, like it was last few years ago, right? Okay, I forgot one adjustment. I want to do that adjustment, right? And that was basically the impairment testing of Beta. So how do I know the impairment testing of Beta? It was actually discussed in here. The recoverable amount was given. So what do we need to do? We need to say the carrying amount of net assets this is total equity. The grossed up goodwill. Why grossed up goodwill? Because it was a proportionate goodwill, right? So what do we need to do? We need to go about this goodwill divided by 80%, which is 0.8. Why? Because we need to have the 100% goodwill. So hence resultingly what happens is that this is what you have, 251,000. The recoverable amount is 235,000. The impairment loss is gonna be this minus this 16,000. The impairment loss is 16,000. What is the impairment loss? The impairment loss is 16,000. So the impairment loss is 16,000. The impairment loss to be recognized is 16,000 multiplied by 80%. 12,800. 16,000 multiplied by 20%. It's 12,800.
So sorry, I missed this. I missed the impairment testing. Can you
Okay.
go over again? Sorry.
See, what happens is that this is the impairment loss. This is the impairment loss of what? This is the impairment loss of the Beta, right? So when it's actually the impairment loss of the goodwill, so you need to understand that it was not 100% goodwill. It was not 100% goodwill. It was proportionate method. So it was like 80% of that. So you have to do it like this, that divide by 80%.
Okay, I get it.
Right?
Yes.
Now, the impairment loss to be recognized is this. Okay. Now what next is there? So let's just try to do the calculations. The Beta was subsidiary for the whole of the year and the Gamma was subsidiary for 8 months. We need to see if there is any intra-group trading between Beta and Gamma. So it was like 42 million here. So it's like minus 42,000. It's like minus 42,000. It's like adding up the unrealized profit, which was 4,800. We were also being told something about the impairment, that where is the impairment loss charged? You're being told something about the impairment loss. Any impairment loss are charged to cost of sales. So if there was any impairment loss that need to be recognized, it was supposed to be recognized in here. So you would add it up to the cost of sales. It's like 12,800. Now, if we talk about the group accounts, it's gonna be like this plus this plus bracket open this multiply by 8 divided by 12, because it was subsidiary for 8 months. So this is how it is going to be, but this is not ending here. Plus the sum of all of this, plus the sum of all these three adjustments. If I apply the same thing over here, I just need to check if the formula is correct or the formula is not correct. Okay, so what we need to do is that we need to see that basically yeah, okay, we'll do it inshallah. Okay, because this needs to be removed, this needs to be added up, this needs to be added up. So what I would do is that since this is all in the minus form, so I would say here this way, since this needs to be added up, I would just say minus in here. I would just say minus in here. So I get the answer now. I get the answer now. Now resultingly what happens is that there is a gross profit that you can get, and the gross profit is gonna be the sum of both of these. Sum of both of these. Now what happens is that we would have the operating expenses. The operating expenses are going to be like this. We just have to see that if there is anything adjustment that needs to be made. So we'll just try to make that adjustment also. Don't worry about it. So hence resultingly what happens is that you have the net profit. You have the net profit or the profit from operations. Then the investment income is 128,000. So in addition to 128,000, there has to be an adjustment of the gain or loss on disposal. So it was like not minus, it has to be plus because it's a gain on disposal. And then what happens is that we'll again copy this formula in here. Sorry, not this formula. This formula. So this is how it is going to be. Then you have got the sum of all this now. 115,887. The income tax expense, again, the formula needs to be copied. And then what happens is that you again have this 814,887. So this is what you have. Now, if I could just apply the formatting to it. So I've just applied the formatting to it. And let's just see that, okay, this is where you have got format cells. The border of the bottom has to be put in here. Then the border of bottom needs to be put in here also. Then the border of the bottom also needs to be put in here. Then here. And then what happens is that we would have, say, let's say format cells, the border again, and then there's a top border, there's a bottom, double bottom. Okay, so we have got this. Now this is what we have got, the profit and loss account for the year. So what was the requirement of the question? The requirement of the question is that consolidated statement of profit or loss for Alpha for the year ended 31st December 2009. Now, in addition to this, so this is basically something that you have done with respect to the group. Have I missed out any adjustment? Okay, lovely. So we have been able to do this question, the name of which was Alpha Company, and it was about preparation of the consolidated statement of profit or loss. So we've been able to do it, and we've been able to present it. I'll now move on to the next question. The next question is question number 2. And with respect to question number 2, it says that theta, a listed entity, prepares its financial statements to 30th June each year. And what else is there? You're a trainee accountant. Yeah, please.
So before you proceed, that does it mean that I don't want to predict, but are we likely to have balance sheets for maybe tomorrow's exams instead of P&L when you study the trend?
Yes,
Because
you're
from
right.
my trend study, I realize that we're likely to have a balance sheet.
You're
instead.
probably right.
It's just a guesswork.
Yeah, I mean, this is probably how it operates, that usually this is how it goes about, but it has not, I mean, like they've deviated from this once or twice also.
All right.
Okay, now what next is there? The next is basically it's about theta. It says that one of our key responsibilities is to prepare first draft of financials and so and so, so and so, so and so. So what are the requirements of the question? Let's try to see them. Now the requirements of the questions are, the requirement of the questions are using the information in Exhibit 2, explain and show how the transactions described there should be accounted for in the financial statements of theta for the year ended 30th June 2000 and for the year ended 30th June 2005. Marks will be awarded for both figures and explanations. Ignore taxation. Your answer to this part should not discuss any ethical issues. So what am I going to do? I've been given one word processing document, and I've been given one of the document for the spreadsheet. So I'll be using both of them. I just copied it and I just pasted it here so that you know that what is going on. Then it says using the information provided. He's asking for the advice, the ethical issue. Okay, we're just going to do that later on also. Now let's just try to understand. See, the first one of them is there is an email. I'm just skipping this email for the time being because this email is about part B mainly. So I'm just skipping that email for the time being. But what I want you to be able to do is that to read through this specific part, there are these different aspects of the questions. So I want you people to read this part, which is like cost of the plant. So like, can you just try to go through it? It says we've constructed a plant and have provided details of the cost of construction, a loan taken to finance the cost of the construction, and some of the details of the environmental damage arising from the construction. Now what next is there's a cost of the plant that is given, and there are other details that are given. Now can you just read through it? I'll just zoom out a bit so that it is like the whole of it is visible. Can you just read out and can you just try to see that what is going to be the answer to it?
So look, man, before you proceed
Yes.
again,
Yeah.
so on the group accounting, is it always the case that the system is modeled in such a way that they've already, maybe if it's a balance sheet under your answers on the spreadsheet, it's to be there and then you do the adjustment and consolidate?
Yes, this
It's
is
always
probably how it is going to be because they have changed the method of examination from an attempt or two.
sorry.
I mean, you see, you will probably get a pre-populated spreadsheet,
Hmm.
and that pre-populated spreadsheet, you would probably be using that spreadsheet and you would be doing the calculations on that.
Okay. So on the answer side, you don't need to copy the whole balance sheet or P&L and now start consolidating, or you
No,
don't need to
they
copy
would,
anymore.
yeah, because you see, it's probably gonna be pre-populated. Now, there could actually be the case that they might actually give you a Word document also, where they might actually require some discussions also. So that could also be the case. But see, here what actually happens is that just like in this scenario, the question that we are doing now, here they have given you a Word document also, and they've given you a spreadsheet also. So you'll be using both. You get my point? We'll be using
Yes.
both. So it could also be the case in consolidation also,
Okay.
right?
Yes.
Okay, now let's see. So basically, now it says that at 1st January 2005, we began to construct a plant which will produce fertilizers. This fertilizer can be sold to entities in the agricultural industries. We completed construction of plant on 1st March 2005. So you completed the construction of the plant on 1st March X5. And then provided relevant employees with comprehensive training course on the plant's operating methods. We begin to operate the plant from 1st April 5. You begin to operate the plant from 1st April 5. But prior to beginning operations, we held an opening ceremony in late April 5 and invited a large number of potential customers to demonstrate so and so. Although we started production on 15th May 2005, this was only at a small fraction of the plant's operating capacity. We'll begin to operate the plant at full capacity from 1st July 2005. Now, okay, now these are some relevant information. The costs which we have incurred on this construction and which I want you to include as part of the cost of the PPE are as follows. So they've given you that these are the costs that we have incurred. Estimated useful life of the plant is 20 years, and we should start to depreciate it on 1st July 5 when it is operating at full capacity. Now, first of all, the financial statements are up till 30th June 2005. So we need to see that what is it that needs to be capitalized, what is it that needs not to be capitalized. I'll just copy all this. I'll just try to paste it, but I'm not able to paste it. So what I'll have to do is that I'll have to do the simultaneous adjustments for each one of them. So maybe, let's say, I would say that the cost of the plant, materials used in the construction is 4,000. Production overheads directly related is 2,000. Allocation of general overheads, this is going to be 0. Okay. Now, production related overheads, it needs not to be capitalized. I'm just going to talk about it. Allocation of salaries of construction staff. Salaries of construction staff. So it's actually going to be like this. 500 is the salary per month multiplied by January, February. And the plant was completed on the 1st of March. 1st of March, right? So it's like 2 months. It's like 2 months that you need to capitalize. Then what else is there? There's basically cost of training of a staff. It needs not to be capitalized. Cost of testing the plant. So that's actually going to be capitalized 200. Cost of opening ceremony need not to be capitalized again. Again, it's going to be 0. So this is the total amount that needs to be capitalized. Now, which is 7,200. Now, let me just guide you that how exactly are we going to answer the question. So it's say, for the cost of the plant that is to be capitalized, the following needs to be considered. First of all, you have got, can you just mute yourself, please? The materials used in the production and the directly attributable overheads will be included to the cost of the plant. The overheads, which are allocation of the administration cost, shall be recognized as expense in P&L as such overheads are not directly related to the construction of the plant. In addition to this, what happens is that the salaries for the construction staff for the month of January and February are to be capitalized as part of the cost of the asset, whereas the salaries for the remaining months are to be expensed out. Salaries for the remaining months are to be expensed out. Now, in addition to this, what's there? The next part of the question is that the cost of training and the training costs associated with the employees is part of operations and is not capitalized as cost of the property, plant, and equipment. The testing cost is included in the cost, and the advertising / promotion cost is again the cost that needs to be expensed out, is again the cost that needs to be expensed. So overall, the cost of the asset as calculated in the spreadsheet will be 72000000. The depreciation of the plant shall commence from the date the plant is available for use, that is 1st April rather than from 1st July. Is that okay now? Yeah, is that okay to all of you? Is that okay to all of you? Construction costs incurred, right? So I've discussed that. I've not calculated depreciation intentionally because there might actually be some connection of the other parts. I've not done the depreciation calculation right now. Now, can you just go through the loan, please? Can you just try to see that what's going on with the loan? Okay, now let's see. It says that on 1st December 4, we borrowed $8 million to partly finance the construction of the plant. The lender charged a lending fee of $200,000, so we actually received a net sum of $7.8 million on 1st December 4. There is no interest payable on this borrowing, but we will repay 8.52 million on 30th November 5. I want you to show a loan figure of $8 million in the SOFP and the lending fee of 200,000 as an additional component of PP. Do not account for the extra amount repayable on 30th November 5. Now just try to understand this thing. So basically what happens is that with respect to the loan, the loan was specifically obtained to finance the construction of the plant. The loan interest shall be capitalized as part of the cost of the plant from the commencement date, that is 1st January X, what is this? 1st January X 5, because this is the date when the loan was available, comma, the expenditure was incurred and the activities were undertaken to complete the asset. The loan interest will be capitalized till, I just need to recheck that, completed the construction and then provided relevant employees with comprehensive training on the plant operating method. We could have begun to operate, but number. Okay, so see what happens is that till 1st March X1, the date when the construction of the plant was completed. The loan interest for the remaining period shall be recognized as expense. In order to recognize the loan initially, the loan has to be recognized at fair value less the transaction cost. The difference between the initial carrying amount of the loan and the redemption amount shall be recognized in the statement of comprehensive income. Shall be recognized in the statement of comprehensive income. Right? So that's how it is going to be. Shall be recognized in the statement of comprehensive income. Now let's move a bit forward and let's discuss things further. So see, how are we gonna do it? We're gonna say for the loan, loan amount is how much? It was 8 million, right? The loan amount was 8 million. 8 million, right? And we are working in terms of thousands. So it's like 8,000. The loan amount is 8,000. And the transaction costs are gonna be 200. So the net amount is gonna be 8,000 minus 200, 7,800. The redemption amount is 8520. What actually happens is that there is going to be the interest cost is going to be this 8520 minus 7800. The interest to be capitalized is going to be 720 multiplied by 2, because for the January and the February you're going to capitalize divided by 12 months. So this is 120 million. That is the interest to be capitalized as part and parcel of the cost of the asset. So as per the spreadsheet calculations, the interest expense of 120,000 shall be recognized in the income statement. Shall be recognized as cost of property, plant, equipment, and the remaining amount of 600,000 shall be recognized as expense. Shall be recognized as expense, right? In the income statement. So that's what you're gonna do. Is that clear to all of you? Is that clear to all of you? Yeah, is that okay to all of you?
Yeah.
Okay, lovely. Now let's move a bit forward and let's discuss further. Now, can you just do something about this environmental damage? Now let's talk about the environmental damage. So it says the construction of the plant caused some environmental damage. When we stop using the plant in 20 years' time, the cost of rectifying this damage is to be $10 million. There is no legal obligation for us to rectify this damage. However, we have a reputation for rectifying all environmental damage we have caused. Since there is no legal obligation, you can forget about it from the point of view of the financials for the current year. A colleague of yours has estimated that an annual discount rate is going to be 10%, and the value is going to be 15 cents in 20 years' time. However, ignore all this. I don't want any recognition of this potential future cost at all. So, so what's happening is that you stop using the plant in 20 years' time, right? So what is going to happen? You would say the environmental damage. You would say, although the entity does not have any, although the entity does not have any legal obligation, although the entity does not have any legal obligation, but the public announcements create a constructive obligation to rectify the damage caused to the environment. So what happens is that an obligation related to the damage shall be recognized at the present value, and the amount shall be added to the cost of the investment. Amount shall be added to the cost of investment. Okay, as the cost of the property, plant, equipment. Right now, what next is there? So if I could just try to say the environmental damage provision. The environmental damage provision is going to be the expected cost is going to be what? The expected cost is going to be $10 million, or you could say 10,000. The expected cost is going to be $10 million, means 10,000. Then what happens is that the discount factor is going to be 15 cents, right? 0.15. The present value is going to be this into this. The unwinding of discount at 10%, because this is going to be the obligation that is going to be incurred from the date you would start using this plant. So this is going to be multiplied by 10%, multiplied by 3 upon 12, so 37.5. So shall be added to the cost. The amount to be added shall be 1500,000. There will be unwinding of discount for a period of 3 months, that is from 1st April till 30th June. The unwinding of discount is 37,500 and shall be recognized in the income statement. Right, shall be recognized. Unwinding of discount is 37,500 and shall be recognized in the income statement. Right, so this is how you would actually do it. So now, the revised cost of the property, plant and equipment will be as under. Cost as per cost incurred for the construction. That is what we have calculated already. That was 7,200. Borrowing cost capitalized. The borrowing cost capitalized is gonna be 120. The environmental provision capitalized is gonna be 1,500. Hence, the total cost is gonna be the depreciation is gonna be what? This is divided by 20 years, multiplied by 3, divided by 12. The depreciation, the revised cost of the asset turns out to be 110,250,000. Sorry, 8820,000. And the depreciation expense to be recognized shall be, the depreciation expense to be recognized shall be 110,250. So the depreciation expense that needs to be recognized is 110,250. 110,250. Yeah, do you people get it now? Yeah, do you people get it? Okay, lovely. Now what next is there? There is this second requirement of the question, and that was about the ethical issues. So you have to talk about the ethical issues. Now let's just try to see that how the ethical issues are going to be discussed. Let's just look at the email now. It says that as you will know that we're just about to begin the preparation of the published financial statements for the year ended 30th June 2005. It's very important that the upcoming set of financial results show a favorable performance. So this is an email from the finance director to the trainee accountant. So if I could just talk about one of them is he lacks integrity as forcing the financial statements to give a good picture. Then what else is there? It says that this will reflect well on the whole finance department, including you. I want these reports to report as high a profit as possible to satisfy the shareholders and boost the share price. Understand you do not currently own any shares. It would be advantageous for you to purchase some shares immediately. Now, this is basically the breach of confidential information, which we also call the insider trading, that intentionally buying shares to force on the expectations that share prices will move up once the results are published. Then what else is there? It says that okay, sorry. Now see, I would like you to prepare draft financial statements for my review and approval. There is a relative complex set of transactions which have occurred, which you may be unsure how to deal with. Lack of competency. These transactions are described. Yeah, I've also included the way in which I would like you to deal with them in the financials. You should be aware that your annual performance appraisal is due shortly, which is due for shortly. Now, that's basically the intimidation threat also. Now, let me just try to explain to you people. See what's happening. The requirement is that using the information in exhibit number 1, identify and explain the ethical issues which confront you as a result of the email sent from the finance director, and whether you should ask for advice from a friend who is not employed by Theta. See, what happens is that from the information that is made available, the finance director lacks integrity as he is intentionally trying to present a picture of the company performing exceptionally well to the shareholders through forced accounting treatments. Furthermore, the purchase, if I purchase the shares, that will give rise to self-interest, threat to my independence, and will also result in so basically what happens is that, let's just try to see this. Now see, what actually happens is that, so this is basically will give rise to self-interest and will also lead to the breach of confidentiality if I use the information to my benefit. Furthermore, if I discuss with a friend of mine who is not working for the company, this will also give rise to a breach of confidentiality. Lastly, the fact that finance director is forcing me to present good information and reminding me that my appraisal is due is an intimidation threat to the independence. So that's what you are gonna say, that's what you're gonna tell them. So basically, that's how we are gonna answer this specific question, and I hope that you people would have understood that how exactly would we be answering such type of questions now. So let me know if this is all okay to all of you, and
So Lukman, is
yeah.
it always the case that you see a question per trend in terms of the professional? Because I felt like this is like professional ethics question,
Mm-hmm.
where I mean you are preparing financials and you have to have in mind all these 4 or 5 ethical issues. So
Okay,
has
I'll
there
just
been?
share some. I'll share something in the Word Excel. I'll share something that what are the ethical things that you should actually keep in mind. So like there is a list which you could just see that what could be the case. Like there
Okay.
could be multiple scenarios. I'm just gonna share one of the list through which you would have an idea that okay, what to look for,
Okay,
right?
that's fine.
Okay, so thank you very much, guys. Thank you for being here. Wish you all the best for the examination, and do keep me posted. Wish you all the best.
So hello.
Yeah,
Can
hello.
we have
Yeah.
this video?
Yeah, it will be available.
on
Like
the
it will take
platform?
around 1 hour's time for us to upload this,
Okay. Okay.
right?
All right.
Okay.
Yeah.
Thank you. Thanks all.
But hello. So hello.
Yeah. It will be shared.
Sorry. I'm sorry. I'm worrying you. So
No, that's okay.
so did you say you're going to share something in Word with us, and that'll give us a guide?
Yes, about this specific code of ethics also, that what do you need to write with respect to the ethics.
Okay. But aside the trend analysis I was doing, aside the consolidated balance sheet, can we expect anything as I mean in terms of?
There have been two times that one time consecutively they gave statement of comprehensive income and consecutively they gave the balance sheet. But generally, yes, the trend is like this, but anything could be tested, huh?
Okay.
Right?
All right. Yeah.
Okay, lovely. So take care.
Thank you so much. Thank you.
Assalamu alaikum.